All right, we got it. So this is the second of 5 webinars we're doing. The first one is up on YouTube. If you haven't seen it, take a second to look at it. I'll keep it up there for a while. This one I'll throw up there as well. But this one we're going to talk a little bit more about order flow and what it means to try to see what other people are doing, right? So I'm not going to get into my bio too much because you guys, I think, for the most part, know who I am. I do want to repeat this, though, at the top. When anger is the emotion that gets you confident, you're in trouble. Said that at the beginning of the last webinar. It is, you miss a trade, it's a winner. You miss a trade, it's a winner. I'm not going to miss this third trade. It's not even a setup of yours. You take it, and that's the loser. And anger got you confident. So you got to remember that. As far as I go, I was a CME clerk, mid-90s. Chicago Board of Trade is the other major futures exchange in Chicago. Became a member of that one in 1999 and a pit trader. Couldn't make any money in a crappy pit, but the transition of this business from the trading floor to a computer kept me in it. And I went from making no money and ready to quit to making more money than my dad and home at 11 o'clock in the morning. But that's a story for another webinar. Anyhow, the transition from the pit to the PC was all about prop firms. And they're not all over the place, but where they are Chicago, New York, and London. And I'll do a webinar more in detail what the difference between a real prop firm and kind of one that pretends to be a prop firm. Even though this is not the same webinar as the last one, I always try to start my webinars with a picture of my family, me on the left, my father. If you know how, you'll have a job. If you know why, you'll be the boss, he used to always tell us, right? And so that's what these 5 webinars are all about, the why. We went through the 2 things that are really must-see patterns or things to look at a chart. So you could check that off the list of these 5 things. Today we're going to talk about order flow and real-time stop hunting on Saturday morning at 10 Central. Learn what no one else is teaching, and that's market relationships. We'll talk about how to review trades on Sunday night, pull it all together on Monday. I think Monday's at 3:30 Central. All of these will be up on YouTube if you're watching this video at some point in the future. But I want to make what's basic to me basic to you. I also said that at the last webinar. I have to make what's basic to me basic to you. What's important when you learn the correct basic skills, they're also the advanced skills in this business. That much I could tell you. Order flow. Why is it important? Let's say you go and buy a car and your cousin's a car dealer or a car salesman, and he says, listen, don't buy it today. Why? Because we're getting all these new cars on Saturdays, new inventory. We weren't expecting to get it. Come in tomorrow. You got a better chance at getting a lower price. So it works if you knew that inside information going to buy a car, correct? Why wouldn't you apply it when you try to go and trade? And yes, Mark, they're up on YouTube. The first one's up on YouTube. Edge Trading Group, search that. Real quick agenda of what we're going to talk about today with this stop hunting, right? It's a big part of order flow because it's orders that you're putting in, I'm putting in, others are putting in. And what we're trying to find, number one, very simply, why stops mostly are used, why they almost have to be triggered and create a magnet when there's a lot of them clustered together. Talk briefly about the footprint, how it could show you where the tempo picks up. In other words, where the speed up or down, why that matters. Baby bird story, very popular story that really paints a picture. And then the most important order flow question, which is the story punch a guy in the face. And it's these stories will hopefully get you guys to retain more, remember it when you see it in real time. Because that's one of the weaknesses of trading in real time is reading the real time. And so it's all easier image and after the fact, but you got to jump into it and create less randomness while it's happening, all right? And as a 20-year screen trader, when I'm trading like crap, I'm reading the real time like crap, all right? So it's not like, well, you figure this out, you can throw it into neutral. You're always working on a better way to see the same thing so it doesn't feel like a good guess. All right. After you sell it, you're a buyer. What do I mean by that? After you sell it to get short, open a short position. Hopefully everybody knows what a short position in futures is. It means you think the price is going down, you sell it, It goes lower, you buy it lower, and you made money. However, it just doesn't always work that way. You have to put, a lot of people manage their risk and use stops this way, stop orders. They use it to exit positions. Now, I know you could use a stop to enter a position, but generally people are using it to exit a position and generally using it to exit for a loser. All right? I know there's trailing stops, but I'm just telling you where most of the stops and how most of the stops are used. To exit and to exit for a loser. So in today's example, we're going to talk about buy stops. All right? And we're going to talk about buy stops because when you open a short position, you have to do what to get out? You have to buy it. So there's buy stops, and they're associated and married to limit buy orders. Pretty simple. You're short. You got a limit buy order below to get out for a winner. A lot of people have an OCO with a buy stop above. Buy stops are above where price is. Sell stops are below. But let's just talk about buy stops. For every buy stop, it's associated or married to a limit buy order most of the time. I'm not going to say everybody uses it this way, and someone might be thinking, well, that's not how I use it. We're talking about the masses here, all right? So when you get short, you have to sell. Makes sense, correct? Once you sell and get filled and have an open position, a lot of people have two things happen. They put a buy order in below, and they put a buy stop order above. You see my cursor. Buy stop above, and that's married to a limit buy order below. The sell goes away because you're already filled. Makes sense? Another sell order or short comes in the market. Two buy orders are associated with that. A buy stop above and a limit order below. Same thing on this third level. Now, I'm putting them around the same price, but it's not exactly the same price these shorts are being opened, and it's not exactly the same price that these buy orders would be put below or buy stops would be put above. But let's just assume that they're in the same area. That's what's going to create a magnet effect. And here's why. In this scenario, you have people who could make money if these buy orders get filled, right? But they're going to lose money and exit for a loser if these buy stops above get filled. All right, so let me put a pen on it. Just put yourself in this position. Before I go through this, how many years have people been trading? Put that in the chat box. Or if it's months, put 2 months with an M. If not, just put 2 years, 3 years, whatever. Take a second. Tell me how long you guys have been trading. And I'll run through this. 10 years, 5 years, 2 months, 15. 2 years, 3 years, 3 years, 2 years. 14 years, 2 years. Good. What do you mean, Mark? What are you talking about? Hold on a second. Hold on. I got to see what Mark is talking about. What are you asking me? You don't understand the question? How long have you been trading for? All right, let's get back to it. So you got buy stops above if you're short, connected to buy limit orders below. Now, just imagine how you feel when you're in a short position and price is moving either closer to your limit order to get out for a winner, or it starts to creep up to trigger your stop. How do you feel when it's getting closer to your stop? After it just comes down and fills you. And you're thinking, should I just take my buy order below and buy a little higher? No, I'm not going to do it. I'm going to stick to my guns and buy it below here. And then all of a sudden, price gets a little closer to your buy stop, and you wish you did do it. So does everybody else. So if indeed there are a lot of buy stops in this area, there are people having that same emotion every time the price ebbs and flows between where a lot of them might be trying to get out for a winner and where a lot of these cluster of buy stops are. If indeed there's a lot of clusters of buy stops, it's safe to assume that there are a lot of short positions. And if there's a lot of short positions, there's a lot of buyers in the market. The first saying is up in here. After you sell it, you're a buyer. So if indeed there's a lot of buyers in the market, there's a lot of this, a lot of buy side emotion. And it's one of the reasons when you have a cluster of buy stops, especially in a tight area, it's a magnet and they almost have to be triggered. They have to be triggered because you can't get this market to go down until you clear out some buyers. If your price just can't go down, your trade just can't go down, and all of a sudden it jumps up and then goes down effortlessly, and you get stopped out and then it goes, that's because you were part of this example. You were part of too many buyers in the market, too many shorts in the market, too many shorts, too many buyers, too many buyers. How could price go lower? So what happens is you get that emotion of people saying, you know what? I'm just going to buy it a little higher. I'm going to buy it a little higher. I'm going to buy it a little higher. And they all chase each other up into eventually clearing out these buy stops. It becomes a self-fulfilling prophecy. And every time these buy stops get triggered, buy order below gets taken away. Buy stop gets elected, a buy limit buy order gets pulled, right? Because its order cancels orders, OCO. What's important now is when you get this tempo, when this is what a footprint could look like, when you get this tempo that speeds up the market to the upside, a couple things could happen. If you follow through, it becomes a really good subsequent support area. If it comes right back through it, it's cleared all these buy orders to go lower. I'm going to show that on some real charts that we had the last couple days, but also with these next two stories about why markets have to do this. I know a lot of people get emotional when you get stopped out and then you change your stop and then you shouldn't have changed it and you're always second guessing yourself, and that happens, especially when you're trading worse. Always seems to happen. It's because you're in locations with too many other people. It's a crowded trade or a crowded boat. You got a crowded boat, you got too many people on it, we got to throw some of them off. In order for a boat to do what it's supposed to do, it can't have too many people on it. If there's too many buyers, market can't go down. So until we throw some people off, boat's going to sink. And that's a shakeout. That's what I want you to remember. There's only so many people that could be on a winning trade. Does that make sense now, Mark? All right, let's get back going. It makes sense. It has to make sense to you that crowded trades aren't going to go your way. And it's a self-fulfilling prophecy that you have to get shook out in order for someone has to get shook out. The market's got to get shook out. Get rid of the dead weight and then go. Now, does that mean in order to be strong, you just hold on to stuff, right? Well, I'm just going to hold on and be a strong hand? No, because you're going to run into those days that it doesn't stop going down and you're stuck and you're going to take a giant loser. Or add to trades. All right? That's not the definition of a strong hand. You have to be able to say, am I coming out? I'm going to show you this as an example of a chart. Am I coming off a pattern where the other guys already got stopped out? In other words, am I on the other side of a valley or am I on the other side of a mountain? What does that mean? On the other side of the valley means there's X amount of people that are long looking for price to go up. on this side of the valley. On this side of the valley, there is less people looking for price to go up. Why? Because of the valley, because price went down. You shook out a certain number of these guys. All it means is that in this pattern, a long trade has just a greater probability to go up. That's the pattern you want to see if you're long. Did they shake out other weak hands, other people who were long? You could always ask yourself that question. When you have an open long or an open short position, look back and say, is there a pattern that shows me that other people who are also long were just shook out? So I'm in a less crowded boat, a less crowded room, a less crowded trade. Because again, if too many people are long with you, price can't go up. Too many sellers above. Too many people are short, hard for price to go down. Too many buyers below. All right. That is kind of a head fake, and I'll show you when they shake out traders, right? Positions. They have to go up to go down or down to go up. Now, the baby bird story, and I'm going to go back to charts and show you when the tempo picks up, when could it be used as subsequent support or resistance? How many people have heard the baby bird story? Most people. Baby bird story is just a story about helpless animals, baby birds. They need something in order to survive. And unfortunately, so do a lot of traders. They're helpless. They feel helpless in an open position, trying to get out. All right. They have to focus on or rely on mommy bird to bring down food and feed them, which in this metaphor is price. Just before price is about to fill their order, a hawk comes in, rips off mommy bird's head, takes price away. The baby birds are left falling out of a tree and getting run over. What does that story mean? When people are trying to get out of a short trade and they're buying at these X's, or trying to buy rather, price shoots up. They're short. Price is coming down to maybe fill these guys who are stuck, helpless, begging to get out of this short trade. Just get me out. And that's when the hawk comes, takes price away. Because of the emotion of maybe one guy saying, screw it, I'm going to just buy it here. I'll buy it here. I'll buy it here. And it runs away. Emotional buyers who are stuck short in this example. Everybody could relate to that. It's happened. Most people that answered my question about how long you traded for have traded for many years. It's happened to you where you feel helpless. You're praying, God, I'll never get short again, and I'll get out when I'm supposed to get out. When does this happen? When does this generally happen where you get a baby bird situation where you just wish you would have got out? Generally, when you could have just got out for a small loser and price just jumped on you. At some moment, the tempo picked up and ran up. When price rallies fast, it's accurate to assume there's a lot of people who missed buying it. And if they miss buying it to cover a short, they still have to buy it, right? The reason why edge zones have a pretty high level of accuracy is because it just measures where price goes up or down fast. Draws a green or red line across. And it's showing where these orders came in quick. Where did they come in quick? And how is that going to help me rely on real time or subsequent support or resistance? That's the feeling, though, that makes good support. Not just the feeling, but that's when, or that's why support works. So the next time you have a line in the sand and price comes in and beautifully rallies, it's because you had a bunch of people stuck short and trying to bid to get out. Short and bidding to get out on their knees, praying, feeling helpless like a baby bird. Eventually, they're going to fall out of the tree and get run over because you're just going to blow your account out. If you continue to hold on to massive losing trades and always are having to beg to get out of that short position you took a lot of heat on. And a lot of times it comes from doing what? With your stop, pulling it, adjusting it. And when price skips up fast, you're like, damn it, why didn't I just get out? All right, last metaphor, then we're going to go to charts. Punch a guy in the face. I like to do this to Carl, but he keeps coming back. This is the most important question you got to ask when trying to read order flow. When the market gets punched in the face with a lot of buy orders and price goes up, guess what? It was supposed to. If the market punches, if buyers punch the market in the face with a lot of buy orders and it goes up, it was supposed to. And guess what? It was probably too late to buy it. Price already rallied for you. What's important to notice when reading order flow is when price doesn't do what it's supposed to do. Shouldn't price go up if a lot of buyers come in? I don't care what it's the price of. A lot of buyers should always dictate higher price. What if it doesn't? That question is what I want people to focus on in 2020. Not this week, this month, this year, this decade. Always, if you could identify where buyers are, and when it goes up too late, it probably wasn't, opportunity's gone. When it doesn't go up and it should, is where your clues are. Your information is your edge. And the information of when something doesn't do what it's supposed to is where your clues are, is what I should say. I often use the analogy of a detective, right? A tell when he's interviewing a potential suspect. A card player, a poker player. What kind of tells does your opponents have? Trying to figure out if they're bluffing or not. We're trying to figure out if the market's bluffing. So if a lot of buyers come in and it can't go down, then there's a lot of ways to look at this also. You could look at and read this, like the Delta rallies, and there's a lot of aggressive buying that comes in. Price doesn't go up. Big buyers or sellers that you could filter out on a footprint. Big orders that lift the offer, and price just can't go up. Edge zones that I have that throw in some green lines, and price is just struggling to go up. Everything comes back to the qualifier of what you're looking to do. If I'm looking to get long and buying is coming in and can't rally it, it's got my hand off the mouse. And generally, it saves me from a low probability decision. So when the market gets punched in the face with a lot of buy orders, it should go up. Just like if I punch Carl in the face with everything I got, he should go down. But if he doesn't, and he doesn't even blink, I'm not that tough. I'm running the other way. So think of these things like punching a guy in the face when you're trying to see and determine big orders that come in or big buying that comes in. Think about, has a market shook off enough of the longs or shorts? With the boat example, think about the baby bird example when you're trying to look for subsequent support or resistance. People stuck short make great support. People stuck long make great resistance. Let's go to a chart. And take a look. Any questions up to this point? Now, don't worry about these dials right now. They're not part of what we're going to talk about today. But this is one of my main screens that I look at. And there's a lot of stuff that I have that people have done, and it's important to understand, like on a footprint, where these numbers come from. And I don't want to spend today's webinar going through why these numbers are what they are. All I want you guys to know and take away from this event is when they go up fast, there's some green that's left behind. If they go down fast, there's some red that's left behind. simple imbalances. Don't get too confused with numbers. If you watch the first webinar, it's about rotations, right? And what happens on those rotations and how they could be these subsequent support or resistance levels. All right. And then when the market doesn't do what it's supposed to do, whether it's a lot of buying coming in, doesn't go up, a lot of selling coming in, doesn't go down, or some great resistance and it doesn't work. If you got great resistance and it's not working, you should be bullish. But let me go in and show an example from, I think this was Tuesday, and then we'll go through today. When you have a market that could be a little longer term, right? But when you have a market that shakes out one side, does it clear the way to go to the other side? This was on the open, I think, New Year's Eve. And I think what we were talking about is if you're trading it right in here, after the fact, it looks like this is a great buy. What the hell's the matter with you? Get long. But you got to be able to recognize this stuff and know where you're wrong in real time because you don't get to see that. But when we were doing the room and looking at this, when you're over here, you're on the other side of the valley I talked about, where the market might have indeed shook out enough longs to be able to go up. Because when you have less longs, what do you have? Less longs equals less sellers above. Less sellers, easier path up. Like I said in the earlier slide, when you open up a position, look over your shoulder and say, did this market by chance just shake out other people who might have been long? Because that's what you want. And those are the patterns you want to start focusing on. Did you see a lot of orders come in the book that were sell orders down in here and the damn thing couldn't go lower because it was floating up here? That's punching the market in the face with a lot of sell orders. It can't go down. Someone's absorbing it. This obviously doesn't work every time. These are all about stacking probabilities to put it together to make your decision making better than it otherwise would have been without understanding these dynamics. I know some people, when they come in to educate themselves on trading, it'd be great to have that magic potion, but you have to understand why markets do what they do and everybody else being trapped instead of just feeling like how you feel when you're trapped. And what changed is what a lot of people ask when they have no idea. And listen, I'm sure there's a lot of people that still feel that this business is very random. I know how that feels. When I was in the pit, I'm standing in the pit looking at everybody else and not having a damn clue as to what price is going to do next. I'm a real aggressive guy, and I'm in a pit and I am paralyzed. I can't raise my arm because I know that I'm just guessing. And so when there's uncertainty, there's fear. And when there's fear, you either do nothing or do something stupid. Fear often goes pendulum swings and you get greedy. I got a saying that if you're fearful, you don't do anything. If you're greedy, you don't do anything for long. You're going to have enough resources. But randomness creates fear. Less randomness creates less fear. You start replacing it with confidence. I'm just trying to give people helpful tips on what's over your shoulder. That's why I don't have a really long leash for smart guys that come in to this environment, because it's like, go back to your mommy's basement. You know what I mean? I think that's where a lot of people are, where you got to just get through all the nonsense and focus on why markets are doing what they're doing. And if you want somebody else to piggyback on, like I said, you might as well give them your money, have them trade your account, and hit the snooze button when the alarm clock goes off. Meet with them once a quarter to see how they're doing. All right, so let's go into today because the other Mark S brought up a good baby bird scenario in the Nasdaq. Let's pull up the Nasdaq. Now there seems to be a lot of lines in here. I don't like this many lines, but just the tempo of the market creates more. I always adjust them. I'm not going to get into what these lines are all about. Again, just every time you see a line, just imagine that the market went up or down fast. Give me a baby bird scenario, Mark, as I'm going through this. I want to see you recognize a couple of them. Here, I'll go over this one. And this isn't, again, what should happen. And then if it doesn't happen, then there's a real high probability the other way. So take a look at this. Take a look at the bottom of this chart pattern. And then take a look at how fast it releases to the downside. Okay. Now, let's say we don't know any of this. All we know is that the market broke down pretty aggressively right in here, right? It got fast right in here. Do you think it's a coincidence when it sent these red lines across, it stopped there and it stopped there and it stopped there? You think it's a coincidence that it got fast in there, sent the red line across, and it held it as overhead resistance? Those are baby birds looking to sell it here because they missed it here. Let me show that again. Sellers that are trying to sell it here because they missed selling it here. And it makes sense they would miss selling it here because how fast it went down. They didn't miss buying it here, went down. Make sense? So then you could look and say, when a market goes fast, a lot of sell stops probably came out, and a lot of people who were long in here wish they would have got out right here. So they're begging to get out right in there. And so the same thing when you get the market that, let's take a look at this for a second. Because like I said, there's too many lines. So what you want to do is go back and see how often lines might have worked, because the more a line works, the less and less likely it's going to work. So take a look at this. The market goes up fast in here, comes down, works as good support, right? We always talk about you want a line to get drawn across. Now the market drawn across here holds as not that good a support, comes right through it, breaks in here. What we talk about is when you have support that usually works and it doesn't, it generally creates a really good opposite effect. You really should be bearish when you drive through an area that should have held. And probably the reason why it held is good subsequent resistance a time or two after. So all these lines, when you separate them out, and they all come from creating someone getting shaken out, someone getting stuck and becoming a baby bird, or just the market finding a lot of selling. Like here, what I like to do is to come into an area of support and to see, and sometimes it goes away, but to see selling come in right in here and the market get above it. So if I'm into support and I see sellers punching the market in the face and it can't go down, that's a trigger that the upside is going to be the right side. So every one of these lines that you see, green or red, have to do with order flow, have to do with the tempo of these orders coming in. And when you're leaving a lot of green behind, that means you're getting a lot of price to move up rapidly. And that usually creates continuation. Today was just, I didn't trade the afternoon, but it just appeared to be a grind to new highs, new highs, new highs, new highs. What has to happen in order to have great continuation? Obviously fundamentals and things like that. But at some point in the morning, you probably shook a lot of people out. So at some point when you rally, you got less people selling above. And sure enough, this morning, right out of the gate, I don't want to say right out of the gate, but we open up at, where do we open? 50? 46? They had a nice sell off. So if you're like more of a swing trader, you look over your shoulders and you say, hey, could this market grind up through these all-time highs? Kind of still a holiday. Today and tomorrow is still kind of holiday-ish. I think Monday is the first official, unofficial day of the year. But volume is light. We're on these all-time highs. You look over your shoulder and say, yeah, you know what? They gapped open higher. They came in, were negative, and then they caught a bid, and they cleared out a lot of people who might have been long before the open, right? They might have been long over here, but after the market slid down, there's less longs, less sellers, easier chance to go up. Now, that equation isn't going to make you $1 million, but when that equation is present, it puts a tailwind behind your opinion. So to recap, the most important question I want you guys to ask: when you recognize aggressive buying and aggressive selling, does it do what it's supposed to do? What is necessary for good support to have in order to work, or good resistance to work? Good resistance has to have people who are stuck long or short. Stuck long, because what are the longs doing? Trying to sell it. So resistance, if you have stuck longs in a certain area that they missed it, they're all baby birds trying to sell it. If you have a lot of shorts equals a lot of buyers. You got a line in the sand, you got all those emotional buyers in there. It creates a good base. Let me walk you through this emotion. And so just also remember, one other really cool thing I'm going to show you. So stick with me. If you got any questions, pop them in. What was I going to say, Carl? You got me distracted with your comments. You guys feel sorry for Carl because I make fun of him. You don't see what he says to me. If I showed people what he says to me, might call the police. I don't want you guys to get confused with all these lines either. There's way too many of them, and there's a reason why there are too many of them, and there's ways to tweak it, and I won't do it till Monday because we're still kind of in a holiday mode. So don't let that affect you. But there's two things. There are sell stops that I want you to remember this. I think if you don't remember anything from this webinar, think about this. Let's pretend that you're looking for an obvious place that you would put your sell stop if you're long. Going off what we talked about today. If you're long, you're a seller, correct? And let's say you're going to use a sell stop to get out for a loser. Sell stops are below, correct? In this moment, right in here, let's just look right down in here. Where's an obvious spot people would put a sell stop to get out of a long before any of this happens? Where's an obvious place to put a sell stop when you're looking at this consolidation? Sell stop gets out of a long. Where would you put an obvious sell stop? Perfect. Everybody says underneath the consolidation, whatever this price happens to be, 37. Underneath consolidation. That's obvious, correct? If it's obvious to you, and don't take offense to this because I use it for myself, if it's obvious to me, like real obvious, then it's obvious to most of the rest of the world. I often look at it to get people to remember, if a fifth grader would put his sell stop here to get out of a long, so would most of the rest of the world. You want to find out what the obvious is and do the opposite. That doesn't mean put a buy stop here. That means that when you fly through an area and you jump back up through it, there's a chance that the upside might be the right side. When you come right back, you look over. That's what I mean by when you look over your shoulder, when you're over here and say, you know what? Anybody long in here, there are probably a lot of sell stops that got elected. And they get cleared out. What does that mean? That means the boat just got relieved of a lot of passengers. Going back to that boat example, if a boat has too many people on it, it can't float. Someone says, hey, listen, we'll float. We got to throw 20 people off. They might throw 30 people off and overcompensate. But then the boat does what it's supposed to do and it floats. How does a market go up? We know what it takes for a boat to float. What does it take for prices to go up? You can't have too many people long. You need to get rid of some weak longs, which means removing some sellers, always creating a path up, always clearing a path to go up. Too many sellers, and it doesn't matter what the price is, it's hard to go up with too many sellers attached to that particular product. So if you could shake out long, you just look at the markets differently. When you shake out longs, you cancel out sellers. And you could kind of keep looking at that to say, did we jump back? That's kind of the idea of a head fake, right? And you clear out people, it's easier to go the other way. When you go down and then jump back into the box, when you go down and jump back up, you know what I mean? You just shook out enough players. So the path to go up or down becomes clearer. Generally, when you get a lot of these green lines that come out, that means the market went up fast. It got through all of this red, which to me, this was this afternoon and I wasn't trading, but if the market gets through all this red, I'm not saying I would have got long and made all this money. I would have said I had horns on. Whether or not I got long, I don't know, but I would have had horns on when it gets through all of this resistance that didn't work. So keep looking for those three metaphors. When a lot of selling comes in and price can't go down, when price goes down really fast and follows through where it started, becomes subsequent resistance. It's baby birds. And then when price just can't go, that means there's too many people in the boat. You got to go down in order to go up. And then recognize that even if you're in a trade or after you open the position, hey, did we just shake out weaker hands on the same side that I'm in right now? Let me just draw a pattern right in here as well. When the market has, especially like a market like gold or oil, Nasdaq, a little less liquid market, when they almost have to shake people out in order to go the other way. Anybody that trades those markets knows what I'm talking about. How many people in here trade the Nasdaq? There's a lot of people that came here today. I'm glad attendance was high. All right, so a good handful of people trade the Nasdaq. How about gold? How many people trade gold? Not as many people as I thought. All right, let's take a look at the Nasdaq real quick. Before we go to this, though, don't forget Saturday, 10 Central. 10 a.m. Central. I think it's the first Saturday morning webinar I've ever done. All right, so let's take a look at this Nasdaq. I don't see anything. I don't see any like a shakeout that could have given me good predictive skills that it was going to go the other way. Honestly, I don't see it. Like in here, it doesn't really shake out too many traders through here, and it still rallies, right? So it doesn't always have to have a shakeout. You just got a higher probability if you're able to shake it out. This is the chart that, well, actually, this is from New Year's Eve. But right in here, like this was a high probability resistance, this 32.34, based on the speed it went down. And this isn't hindsight stuff, guys, because when you're in the trading room, I'm talking about it. And when I'm wrong, I'm not wrong for long. That's the most important part that you could take. Another thing you take from this webinar is be good at being wrong. Your spouse will like you more, and so will your trading statement. Don't be wrong for long. It's okay to be wrong. It's not okay to be wrong for long. When you're wrong for long, that means you're adding to losers. That means you're taking big losers. That means you're moving your stop. Just look for other people's stops. Oh, this one I want to show you real quick. If you have a market like gold or the Nasdaq, and you could say that it had some swing lows that were obvious and it gets through, just like that S&P example I gave you, and it jumps back up. Markets like gold and Nasdaq, they do this a lot, and it creates opportunity to say, hey, you know what? I'm not going to get long gold until I see it go through some obvious sell stops. So when you're hunting for stops, look at where the tempo comes out. The footprints show you that. These edge zones show you that. Where the volume gets thin, you get a lot of sell stops that get triggered. And then you could assume that a lot of people wish they had sell stops there. And then that creates the whole baby bird story. So look for obvious like swing lows or consolidation lows. And when we just barely make a lower low and then jump in a market, especially like gold, you shook out what? You shook out longs, bottom feeders. Everybody's looking to buy a big break. And I'm guilty as charged a lot of times. Everybody is looking to buy a break. They're looking to catch the bottom for the rally. And the market can't have too many people long. The definition of a bottom is it shook out most of the longs. Less longs, less sellers, clearer path to go up. So what market is this now? This is the Nasdaq, right? So when you're walking through any kind of market and you're like, it just grinded up. So it really didn't give you a chance to get on the team that much after it ran up through here. And this is 1 o'clock Central, right? When you finally get through good resistance, and I'm not saying, hey, what's the matter with you? You guys should be long in here. This is easy. No, it's not easy. But I try to keep people off the wrong side first. So when your market's in here, it got through some good resistance finally after stopping in there and creating it in there and having a swing high in there and finally goes out. So it's like, hey, this market's bullish unless it jumps back below this yellow line. It's probably got a lot of stuck shorts in the market and their baby bird in there. They don't even get a chance. Mommy bird don't even get a chance to feed them. Man, this is just a grind. You know what happens on days like this to a lot of people? I mean, even if it trends slowly, you're even fast, but when it trends slowly, people are lulled to sleep thinking, well, it's got to come back, and it's just 4 ticks up, 2 ticks down, 5 ticks up, 2 ticks down. And it just slowly, hey, and what I say is a slow moving freight train is going to run you over, just like a speeding train will. It's still dangerous to be on the tracks. So people who can't get out of losers and fade, have a giant hole in their account. And then if you add the losers all the way up, that's catastrophic. And so one of the things I'm trying to really underscore in these 5 webinars I'm doing for everyone is losers add to losers. Don't do it. You wouldn't be allowed to do those things if you worked in a prop firm. The stuff I'm telling you now is the stuff that I learned on the floor, but then in a prop firm. And it's got to be basic to you. The dynamics of good support, good resistance, why they would work, stuck traders, where they're trapped, selling comes in, can't go down, buying comes in, can't go up. This market closed on their highs today. Any questions before we sign off and see you guys Saturday morning? I want you to go to get this free PDF ebook because it puts into words a lot of the stuff I talked about on webinar 1 and this webinar. What are we going to talk about? I forget. The third video. Nobody remembers? Oh, market correlations. Market correlations. Dale, you're on the ball. That's right. Then trade review on Sunday night, and then we'll put it all together on Monday afternoon. I think Monday is at 3:30 Central. It might be at 11. But you guys signed up for this one. You got all the times and dates. I'm going to talk about them as we go through. I mean, I was going to do that towards the end, Jason, but since you ask, what do you use now? I'll ask you guys this because I mentioned this in the webinars about platforms. And there's no interest I have in platforms. And so I've been using Sierra. So when I'm giving you this opinion, it's there's no strings attached. There's no bias to it. So I've been using Sierra for about 14 months and I really like it. So if someone asks me, what do you like platform wise? Sierra charts is what I would say right off the cuff. And you get a lot with it. You get some TPO stuff. You got heat maps. You got footprints. They call them number bars. You don't get these edge zones. That's something I had a developer put together. But you get a lot of bang for your buck. You get more for less. And in this industry, that's hard to come by. Fernando, good to see you. Monday's at 7 p.m., Ron? Man, I didn't want to do it that late, but I guess I will. Thanks, Carl. I'll do the opposite. Yeah, well, then if it's Monday at 7 p.m., that's what time it is. That'll work. Oh, here's what I want you guys to do. And this I'll have work for those watching this in the future. Go to the website, and this is free. You don't have to buy anything. Go to the website, and if you're a unique visitor, meaning you haven't been there. You should have a wheel. Everybody wins this PDF ebook. Let me show it to you so I don't get 100 emails. Oh, that's how you do it. I got to be a unique visitor, so hold on. All right, so edgetradinggroup.com, it looks like this, right? When you take your cursor off it, a wheel comes up. Just put your email in there, spin it, and you'll get an email that comes with this PDF ebook. It's like 22 lessons. You'll like it, trust me. Some of it, the first few are kind of basic, and then it gets in, but it's all putting words a lot of people like to read and really help understand stuff. That's what that is. And it was done, was pretty decent. Hold on. Now I was going to show it to you, but you guys, you'll like it. Trust me. Spin that wheel and you'll like it. Email me if you can't get it, and I'll lead you in the right direction. Anthony@edgetradinggroup.com. So good question, Mark. Do I set targets on my trades like a fixed scale, a certain number of ticks, or do you scale? And I like to scale number one, and I fix a lot of times 2, 4, 6, but then adjust them based on what might be in this, where the edge zones might be. So for instance, if I'm short up in here, Mark, and I'm not looking to take 2, 4, 6 ticks, but that's where I'll have it roll out, and then I'll adjust some of the profit targets to be right above a target that might be potential support with one of these zones. All I'm trying to do is foul tip until I can get something I could hit in the gaps. So I don't scalp. I scalp if I'm not getting good locations or the market's not fitting my style. But I'm just trying to find that one trade that is the full winner. So I think that, like to your point, when anybody says that using market context, when you have good support resistance level, it's already including the context for you, right? It's showing you where the market sped up, so that's probably good downside targets. Maybe a good entry, but definitely a good exit. So it's building in the context for you. Yeah, you gotta foul tip. I don't encourage people to scalp, and that's how you're going to make your money. I encourage people to look at smaller losses, and that's relevant or relative to different people. But you're not looking to take full loser, full winner on every trade necessarily. You want to pick good locations. And as we go through these 5 webinars and pull it together, like in the last one, it's like the definition of a great location is price goes your way sooner rather than later. You start getting paid sooner rather than later. That's always the definition of a good investment or a trade. You start making money on it right away. If you buy a house and someone offers you $100,000 the next day and you only paid $300,000 for it, hey, something worked. And I know that's not always possible in trading, where every time you get in, it's effortless, but you also don't want it to be effortless to take a loser. Like how many times you get into a trade and wham, it's right against you. If you would have waited 2 seconds, you got it 3 ticks lower. You want to avoid as many of those as possible. So by trying to pick good locations, getting good at picking good locations allows you to be in bad spots less. So on Saturday morning, again, if you guys are watching this in the future, it won't matter what the day was, but they'll be up on YouTube. Saturday morning, 10 a.m. Central, we'll talk about what nobody else is teaching, market correlations. And you don't have to take my word for it. Look for market relationships and correlations, looking at other markets when you're trading one market in anything, and Google it, see how many people are not teaching it, talking about it. You'll find all kinds of people talking about order flow. And most people don't really ask the right questions with order flow. Order flow is why support resistance works, why the most important question I want to leave you with is always say, hey, buying came in, why didn't it go up? Selling came in, why didn't it go down? If in fact that was the case. The email says 11 Central. Thanks, Ron. Whatever the email says is correct. Ron's on the ball. Ron, if I had a gift, I'd give it to you. 11 a.m. Central. Saturday, right? I'll be there. But here, this is what's with these zones. Like, there's too many lines unless you know what they kind of mean, right? So when a market finally gets above what could be deemed good resistance, it's bullish. So all these lines in here, they're in a tight area. This is the Nasdaq still. No, it's the ES. So they're in a still a pretty tight area. When it gets above it, I'm not saying you can get long in here. Just careful trying to get short, fighting it. It finally burnt. Here's the reason why this works. When it finally gets above resistance, it's gone. Because most people, they don't use resistance until they see resistance work. So resistance works. It works again. It works again. And now they're saying, hey, that's great resistance. I'm gonna sell it. That's when you get most people on the team short, creating a lot of buyers, like we did in that first slide, first example. And you say, I see it working here, I see it working there, I see it working there. As soon as I get it, it doesn't work. Part of anger giving you the confidence. You don't want anger to be the one to give you confidence. You got to read resistance as it's developing because you can't be in when it's obvious. Find out what's obvious and do the opposite. Let me find out when this is Saturday because I'm getting conflicted messages. It's all right to string this out in case I get any more questions here. It's 10 a.m. Central, Ron. I'm pulling that gift back. Saturday, January 4th, 10 a.m. Central. Does the email say 11? If it says 11, we're in trouble. No, it says 10. All right. So 10 a.m. Central, you guys. I'll be there. Hopefully you guys are too. Oh, Ron, you might have got a special email. Maybe I purposely invited you late. Monday is 11 a.m. There you go, Jim. Thanks. So today was 3:30. Saturday's 10 a.m. Sunday 7 p.m. Monday's 11 a.m. Central. And this all won't matter for those that are watching this next week and beyond because I'll post them all on the YouTube and you can go through them. One thing I don't want you to get confused in all these lines. They mean different things. It looks confusing, and for the first time, it would be confusing. So don't let that, it's a whole nother webinar. It's a whole nother program to walk you through the differences between some of these lines. All right, let me post this so everybody sees it. In your chat, the remaining 3 webinars, Saturday, Sunday, Monday, and they're the times, January 4th, 5th, and 6th. I think that going forward, though, for you guys, the 6th is Monday and probably the official start when most people are back at their desks and volume gets to be a little bit more normal. We're running light these last 2 weeks, which is as expected. But I don't think so, Ron. I'm taking your gift back. Maybe next time. Any more questions about? Let me fly through here, see if there's any questions I might have missed. Yeah, you're right, Fernando. I should. Did that answer your question, Mark H, about exits? All right, Dodge. We'll see you. That's what's important. Is like for my exits, I don't like to use stops, but I don't also like to say that, and then others don't use stops, and then something happens and they get their face rearranged, and then I'd feel bad. But you have to have an ultimate stop. Like if maybe your internet goes dead or you lose power or whatever, but also just like that disaster stop. But what you really have to understand is even if you're not using a hard stop where you physically are putting an order in the book, you have a mental stop. And that's what I have. It's like, okay, I don't want to be, if I'm playing it short in this range, I don't want to be short if it gets too much above there. Not right above there, because I don't want to be part of the head fake. And if I'm short from in here, I don't even want it to approach there. So I have a mental stop or a price. In other words, I know where I want to get out before I get in, especially for losers. Thanks, Carl. You know what I mean? I want to make sure that I don't want to be where everybody else is. I want to be a little either above or below that. And chances are below that. I don't like putting my buy stops where I think others are, but because I already know I'm wrong there, or I'm going to be a victim of the head fake. Either way, that sucks. So if I'm short and it's working for me, I'm using something where I don't think a lot of other people are using for a sell stop. I covered a lot of stuff, and that's why it's good that I record it to go back, because I don't know if I covered well enough why sell stops, for instance, are magnets. So go over that, and just, it's a self-fulfilling prophecy. Just think of yourself. When you got a sell stop and the price starts to get close, you get anxious, don't you? And sometimes people just buy it. So if there's a lot of sell stops, people are anxious to buy it. And if people are anxious to buy it, price generally goes up. It's like you didn't care about buying that house and you found out two other people want it. Now all of a sudden you're anxious. So that's why sell stops or buy stops, if there's a lot of them, become magnets and almost have to get triggered. Very few times, if you have a ton of sell stops, and very few times are you going to, if you have a lot of buy stops, I'm sorry, I said sell stops. If you have a lot of buy stops above the market, that means there's a lot of people thinking the market's going to go down, and it generally doesn't go down if a lot of people think it. So you got to clear all these guys out in order to go down. You got to elect all their buy stops in order to go lower. But every time you get buy stops and people go to it, they're like, oh, geez. You get nervous. You get anxious. And it becomes that like blinking marquee. And that's the other reason why I don't like when people have, you're so emotionally tied to where you're out for a loser. So you got to be disciplined and know where you're going to get out before you get in. But don't get so disciplined, or don't get so worked up about, oh, it's getting close. As soon as it trades there, I'm out. Oh, I thought I knew it. I'm just glad to be out of this trade. And then it goes down, and then you're really mad. It's just like, this is part of the business. It's just like, hey, sometimes it's going to get stopped out. Sometimes I'm not. I'm just trying to avoid being with a bunch of other people with buy stops in that area. Let me be on the other side of the mountain. Let me be on the other side of the valley. Let me make sure that pattern exists before I open my position. And you don't have to you don't have to look for small winners, but look for smaller winners than you have been looking for. That'll help you. And then get good at pushing it out. If you're always test, then your style is not fitting the market you're trading, period. If all your winners are tested like crazy, you're looking for too big of winners, or your style is just not conducive for the market that you're trading. And you're going to have to make a change, either in the market or your size or your appetite. Most people have, looking for big winners because, what they see here, I see the opposite, but what people see here is the price went from here at 12:30 this afternoon and they closed up there. And then they do the math. Wow, that's 42 to 51. All I had to do was buy a one lot and I would have made 14 handles, and I multiply that by 4 and I multiply that by 1250. Ooh, maybe I'll do 2 contracts. That math doesn't work. That's not going to work because they're not just going to go straight up. It looks like it goes straight up, but there's a lot, and this is a good rally, and still there's a lot of emotional capital and roller coaster that you're on in this pop. So you got to be careful doing that kind of math. The bigger winner you want, the harder it's going to get, or the harder it's going to be. Just make sure you know that. Nobody goes in there and starts bench pressing 300 pounds. Very few people could go into a bar and, pick up the 3 prettiest women in the bar. There's not too many of us left. Got to work up to it. All right, guys. I think that's enough for this afternoon. Don't forget, tomorrow, doesn't mean anything for those watching on recording, but ISM comes out tomorrow. Unemployment doesn't come out tomorrow. It comes out the following week, the second Friday, because the first Friday of the month is the third day of the month, or the year, rather. So they're postponing it till next Friday. Know that going into tomorrow. But if I don't see you guys, have a safe weekend. Hope to see most of everyone on Saturday morning, 10 a.m. Central. I'm going to be doing it from a mystery location. I'll see if anybody knows when I'm there. Go and spin the wheel on edgetradinggroup.com and get that PDF. If you can't get it, email me, and I'll send you out what you need. Thanks, Tom. Thanks, guys. We'll see everybody in the trading room tomorrow or Saturday morning. All right. Happy New Year to you guys, too. Thank you.